Hello, friends. We have chosen three banks for our equity evaluation project. I'm Vinita Chavali and I'll be handling Citibank.
Hi, I'm Rohit and I'll be
Hi, I'm Samraki and I will be handling Wells Fargo and Company. Here are some of the financial metrics. The stock price of Wells Fargo and Citigroup are close to each other, whereas CIT slightly is less. The beta value of Wells Fargo is less than 1 and hence is slightly less volatile than the market. Citigroup and CIT have beta values of close to 1.6, which means that they are more volatile than the market standards. The PE ratio, profit margin, net income, and revenue of WFC and Citi are comparable to each other, whereas CIT lags much behind. We should analyze that in some time. Let's start with Wells Fargo and Company. When compared against S&P 500, Wells Fargo is running below right now, most probably owing to last year's scandal, but will pull itself up and analysts recommend to buy it. Here are some of the financials. The dividend growth rate is around 7.2%. It will stabilize at around 2.9%. The earning per share is at 4.42 right now, but it will grow steadily in the next few years. A good benchmark of a bank is when the net income is more than 10% of the stockholders' equity. This shows that it is exceeding its cost of capital. Also, when compared to its peers, the return on average common stockholders' equity is on the higher side. For long-term investors, it's hard to find a better stock than Wells Fargo as stated by Yahoo Finance. Hence, as per our analysis, it is evident that WFC is undervalued right now and it is a good investment in the long run. So I'd go long term.
Hi. Coming to Citigroup, as we all know, it's a big budget bank, and as per the analyst ratings, it is suggested a strong buy. Also, the compared to the market, it's performing better than the market right now, and also I would like to bring into your notice some points that enhance why you should buy Citigroup right now. First of all, it's earning per share growth. The earning per share growth of Citibank is 9.35 from past 3 to 5 years, and the projected EPS growth of Citigroup for 1 year is 9.40%, which compares favorably with the industry average growth of 8.56%. Also, the growth in core business. Citigroup has been taken steps for growth by reducing expenses and streamlining its operations. The company has been lowering its branches, improving digital channels, and also making investments in several areas in order to improve efficiency and profits. Another point being impressive capital deployment. The company declared a solid hike of 68.8% in its common stock dividend in July 2016. Also, it has a share repurchase program in place. These activities reflect its capital strength and commitment towards rewarding the shareholders. Also, Citibank stock seems undervalued. Citigroup has a price to book ratio of 0.78x compared with the broader industry average of 1.37x, and based on this ratio, the stock seems highly undervalued. Also, as per our calculation, the fundamental valuation points to a fair value of $74 per share, whereas it's running at 69 per share in the market right now. So as per our analysis, it's the right time to buy Citigroup share right now. Let's move on to CIT Group.
Well, CIT is our dark horse. It is a bank holding company and has two business segments, namely consumer banking and commercial banking. As you can see here in the slide, most of the recommendations are for buy. Going further, more analysts would suggest buy the share as comparing to sell the share. This is just because CIT has performed well over its peers over the last 1 year, which you can see in the slide. And the future suggestions indicate that over a year, it, it is going to increase by 10%. This is due to the fact that the earnings growth that is forecasted for CIT is well above its industry peers. All of this has happened because of the current restructuring that is going on in the company. CIT Bank is a part of CIT Group. Assets which are not part of the CIT bank has come down drastically from 86% of the total assets to 33% of the total assets. Our valuation suggests the price of the share of CIT group is undervalued. It can also be seen by the price to book ratio, which is 0.9 for CIT group as compared to the industry average of 2.49. This suggests that we should include CIT in our portfolio.
So, to conclude, as per our comparison, we have come to the conclusion that all of our subjects are good sources. So, we would suggest a strategy of allocating approximately 30% to each of Citigroup and WFC and risking a 40% in CIT Group.